Great. Thank you so much. It's great to be here and see some familiar faces in the audience. I am Erin Cho. I lead Mayor Brown's ERISA fiduciary practice. I've been in this space for over 25 years, and I'm joined today by my partners, Adam Kanter, who leads our investment management practice. Adam is an expert in the Advisors Act as well as Investment Company Act. And we are also joined by Rick Nowak, who co-leads our ERISA litigation practice. So we're going to give a very brief overview of the executive order, assuming most of you have read it. And then we're going to try to do our best to be a little bit of a crystal ball here in terms of trying to predict what we may see from the regulators. I'm, of course, going to focus on the Labor Department, Adam, the SEC, and Rick will focus his remarks on ERISA litigation and ERISA litigation reform. So, if you wouldn't mind just turning to the next, our first slide. You're great. So, as many of you know, the EOs, took the position of trying to democratize access to alternative assets for defined contribution plans. It's really part of this administration's effort to perhaps, focus on more of the retailization of products that have traditionally been available to institutional investors as well as wealthy investors. The EO encourages the agencies, the Labor Department, the SEC, or other agencies to create an easier pathway for defined contribution plans to offer this asset class in their plans. And the EO lists assets that, including, of course, private market assets. It includes real estate, crypto, which of course is a favorite of this president. And it also included, to my delight, lifetime income investment strategies, which I historically have not viewed to be an alternative or private market asset, but hey, I'm of course, perfectly fine with that. So, so I don't see this as, some folks noticed that hedge funds weren't included. I don't view this as just an inclusive, list. I think it's just examples, perhaps. And I think I would think hedge funds and other asset classes that may not be specifically mentioned here are, of course, are included as well. So, next slide, please. So, okay, so just to make sure we're at the same starting point, the executive order in and of itself does not change existing laws. Private market assets have been available in defined contribution plans for nearly 2 decades. I think our firm has been working on them for over 15 years. The first asset class in this space was real estate. I think there's been somewhere hovering now currently around 40 billion of real estate products in defined contribution plans. Now, another I think fact that I really do also want to get straight because it has not been accurately reported in the media is that we are not talking about a private equity fund or a infrastructure fund or a hedge fund being offered as direct investment alternatives under a defined contribution plan. These products and the way they are structured are heavily regulated. And they are dictated by constraints, not necessarily just by ERISA, but also by the SEC, and Adam will touch upon that as well. So they've historically, and they continue to be offered primarily as part of a sleeve of a larger target date fund, a multi-asset class fund, or a managed account strategy. In each of these cases, the investments in private markets is managed by a sophisticated registered investment manager who is subject to ERISA's standard of care. So, and then the EO does not even make any suggestion that they should now start being offered as standalone investment alternatives. So next slide. So I'm going to talk a little bit about, the Department of Labor and what they are directed to do. So the EO in and of itself directs the Labor Department to re-examine existing guidance on fiduciary duties under ERISA. And that is covered by a statutory provision, Section 404. And 404 covers the ERISA duty of prudence for ERISA fiduciaries. It is known to have the highest standard of prudence known under the law. It also covers the requirement that plan assets be diversified to minimize the risk, of course, of large losses. So we may, in my view, perhaps see additional regulatory guidance under 404. It also, you know, wants plan fiduciary committees, I think, to have better guidance on what factors or helpful guidance they should be looking at in terms of evaluating one of these investment products, whether it be a fund that includes an alternative asset sleeve or lifetime income. So I think we all may be seeing activity, in this space. And so if you turn it to the next slide. So we probably will see probably two types of activity. One is formal rulemaking. So they could issue, modify the regulations under Section 404 of ERISA, which it will go through, perhaps take a longer period of time because regulations go through a notice and comment period. They also may, I think, and what they have done already, is issue sub-regulatory guidance. And the department does that either by issuing advisory opinions, information letters, or tips. And so we have, or fact sheets. We have seen this sub-regulatory guidance issued over the years with respect to investment products. The pro of sub-regulatory guidance is that it can be issued much more quickly. It doesn't have to go through, for example, a notice and comment period. The con, of course, of sub-regulatory guidance, as we have seen over the years, particularly with respect to issues or investment products that have been politicized, they can easily be pulled by the next incoming administration. So next slide. So yesterday it was very interesting. The Labor Department, well, not yesterday, but 2 days ago, issued an advisory opinion to AllianceBernstein with respect to its lifetime income product. So the AllianceBernstein product is essentially a target date fund, which has an annuity component, and it allows participants in that fund to insure a portion of their account balance, thereby allowing when the participant retires, they can withdraw a steady guaranteed stream of income from their retirement account, even though the account may be exhausted due to poor investment returns, or a participant may outlive actually his or her retirement savings due to longevity. And the advisory opinion is very helpful because it permits AllianceBernstein to allow its product to be included as a qualified default investment alternative, or QDIA, under a defined contribution plan. QDIAs are somewhat the holy grail. If you're a manager or a product sponsor, you would love it if your product can be offered as a QDIA, because many participants in 401k plans actually fail to select its specific investment options. And so if a participant fails to select certain investment options for their 401k account to be allocated to, it automatically defaults into a QDIA product. So just looking at the assets that are in QDIA products, they are considered in a way like the holy grail for product sponsors, because there are a lot, and we could probably figure out the numbers, but this market is $12 trillion. And so there is many trillions, I think, in the QDIA funds. So a very good advisory opinion. Lifetime income products have bipartisan support. Again, they were mentioned in the executive order. I think studies have shown that, particularly with respect to retirees who don't have a lot in retirement savings, they can be very helpful and provide somewhat like a defined benefit like option, within a 401k plan account. So they're growing in popularity. They are complicated. These products do tend to be more expensive. And so my sense is that we may see additional guidance in terms of perhaps a regulation under 404 or additional sub-regulatory guidance to help plan fiduciaries evaluate lifetime income products, and I think also products that could include alternative asset classes. The other very interesting thing about this advisory opinion is that the inside scoop is that this request was made to the Labor Department 8 years ago, but yet just earlier this year, the Labor Department apparently made a decision that they were going to issue this advisory opinion. So they got this opinion out actually just within a couple months. So I think to me that is a pretty fast time frame. So it seems to me that if you can get your proposal, to fit within this administration's agenda, there could be hope that it can be issued fairly quickly, particularly with respect to sub-regulatory guidance. So next slide. Okay, so the other very important thing, I think, is for the momentum to be shifting, and I think not just with respect to, of course, the policy, support we now have for alternative assets in 401k plans, is that there's major changes that will be happening within the next few weeks at the Labor Department. So we have Dan Aronovitz, who is just confirmed, and he will be leading the Employee Benefit Security Administration, which is responsible for overseeing health and welfare and retirement plans. I think Rick will mention a bit more about Dan and his background. And Tim Hauser, who has been a very influential figure, if not the most influential figure at the Labor Department. He has been at the Labor Department for 34 years in enforcement, and also the director or deputy assistant director of program operations at EBSA will be retiring next month. So I think this is a very important development, because Tim has not been a supporter for alternative assets in defined contribution plans. The 2020 information letter, which was issued during the Trump 1 administration, was, of course, a policy, position in support of alternative asset classes. And then as soon as Trump left office, the Biden administration walked back that letter quite a bit. And I think that was, again, under Tim Hauser's influence. And we've seen a similar shift with respect to crypto assets. I think it was very well known within the ERISA community that Tim and most staffers there were wary of the appropriateness of crypto assets or digital assets in defined contribution plans. And so during the Biden administration issued a letter, sub-regulatory guidance again, warning fiduciaries that they need to exercise extreme care when considering digital assets. Extreme care, it seems to be even more heightened. I don't know, it's just than ERISA's prudent standard. And now I think, as many of you already know, that guidance was rescinded by this administration. So I'm going to just kick it over to Adam, my colleague. And Adam, why don't you take off on where we may see from the SEC?
Absolutely. Thanks, Erin. So we're going to switch over to the other side of the ledger, over to the SEC side of things. And, I think it's, in some ways, the SEC's mandate here is a little bit more narrow than DOL. But what is the EO directing the SEC to do? It's to look at ways to facilitate access to investments and alternative assets, as Erin kind of laid out earlier on the DOL side. So what might we see here? What it was teed up in the EO is potential changes to regulation and guidance, specifically related to the accredited investor and qualified purchaser definitions. Why are these relevant? Well, we're often really solving for Investment Company Act issues when it comes to funds that are available for investment through 401k and other defined contribution plans. Let's roll forward one more slide and talk about kind of the current state of play and why any of this is relevant. The SEC staff has had a long history of engagement with fund sponsors on how the Investment Company Act really interplays with the availability of certain types of funds through these defined contribution platforms. Erin mentioned earlier, there is decades of experience of real estate funds and other alternative assets being on 401k platforms and in the DC space. How is this all being done? And essentially, it comes down to there's a set of no action letters. You'll sometimes hear them referred to by Panagora. It's the Panagora line of letters, and Panagora really was it was kind of the problem letter. And then subsequently, there were cures that were created by the staff over time. Panagora essentially said if you have a fund that's relying on Section 3C1, that's the Investment Company Act exclusion that essentially says you need fewer than 100 beneficial owners. The Panagora letter said, well, if you have a DC plan investing in that fund and all of the participants in the DC plan get to choose, I want to invest in that fund, well, then the fund has to consider each of those investors to be a beneficial owner for purposes of that 100 investor counting mechanism. And you can quickly see that that's going to be a problem. You're never going to be able to offer a 3C1 fund on a DC plan or through a DC plan if you're going to have to count those individual owners. Now, what they ended up doing was a few years later, and then through subsequent guidance that also picked up 3C7 funds, the qualified purchaser funds that were created later on, they essentially said, okay, well, if you put in place a mechanism for these, generic investment options, to invest in several underlying 3C1 or later 3C7 funds, then you can consider the plan rather than the participant to be the investor. And therefore, it's a lot easier to count a plan as a single investor or a plan as will be able to qualify as a qualified purchaser that permits more feasibility. And this is often how these are done through managed account solutions available on DC plans. Now, the other way that we often see this come up is not following necessarily the Panagora line of letters, but using a different mechanism under the Investment Company Act and essentially saying, well, what if we have a private investment fund and we have a 3C11 fund, a collective investment trust that sort of sits on top? And the question then becomes, well, was that CIT, was it formed for the purpose of investing in an underlying 3C1 or a 3C7 fund? And depending on the fact and circumstances, people often get comfortable that it was not formed for the purpose, depending on the amount of assets that CIT is investing in the underlying fund. Typically, it's going to be a 40% limitation, can vary based on facts and circumstances. But essentially, what that really means is that, to Erin's point from a few minutes ago, we often see and already see prior to any changes under the EO, funds, private funds available through DC plans, but they're in the form of target date funds, multi-asset class funds, and these managed accounts where you have these two existing paths that are unchanged by the EO, that predate the EO, that essentially say, if you fall into either path, then we don't need to consider the individual plan participants. And yet we still have qualifying investors that are, accredited investors and qualified purchasers that don't cause problems for an underlying private investment fund that's a 3C1 or a 3C7. So what does all of this mean, and what potential actions might the SEC take as a result of the EO? Let's roll through one more slide and talk a little bit about some of the things that we're seeing or may see. The other way to think about democratizing private assets is through registered products, right? And so there are a number of registered closed-end funds that invest in private assets. Historically, the SEC has sort of imposed by policy a requirement that you have accredited investors that are in those funds, or that you're limiting the investments of those funds to no more than 15% in private funds. This has now, we'll talk about it in a minute, but this position was walked back and actually withdrawn in August. We've also seen a pullback in SEC activity regarding crypto assets. It was, I would say, a strong regulatory and enforcement initiative during the last administration. This administration is focused much more on fraud and less on sort of run-of-the-mill, just crack down on crypto as a general proposition. So let's go forward one more slide and talk about where we are right now, which is, we know that the current SEC chair, Paul Atkins, wants to work with DOL in, again, this democratization of private markets in 401ks, but did signal that appropriate guardrails are going to be necessary. And so what does that really mean? I think part of this is, you can go to the, extreme end of the spectrum and say, well, Is the SEC going to revisit Panagora? Are they going to say, rip the whole thing up, start all over again, and say, hey, now, unlike what Erin said a few minutes ago, just go ahead and put that private equity fund right on as an investment option on the 401k plan. That seems unlikely. That's probably not appropriate guardrails. But will we see something short of that that's still revisiting some of that earlier guidance to maybe simplify, make more straightforward, maybe reduce some of the restrictions from that line of no action letters that does permit um, these plans to invest indirectly? Will we see a simplification of that? Entirely possible. And we did see at the same time changes on the registered closed-end fund side that have made it more simple for closed-end funds available to the general public to invest in private funds. So essentially what we're seeing is you can invest in a registered closed-end fund that can invest theoretically up to 100% of its assets in private funds without being an accredited investor, right? So that would give parity to a 3C11 fund that was going to do the same thing, right? If they were to, if you were to go in that direction. So I think we're seeing potentially movement towards making it simpler, because again, one of the other issues that to sort of just underline the point, the reason that you couldn't say, oh, well, why couldn't we put a 3C7 fund on the platform and say, well, only qualifying employees could invest in that 3C7 fund? Well, that creates tax issues for the 401k, because now you'd have a plan that is not available to all the employees, and it is not uh, uh, might not be a qualifying plan anymore. So like you to address the securities law issue, you need to, we need to address that while we're also maintaining the qualification of the plan. Let's go forward one more slide. So as I mentioned, we may see some either rulemaking, and we have seen on the spring 2025 regulatory agenda, which just came out a week or so ago, there is an item on there for updating the exempt offering pathways. What exactly does that mean? Somewhat unclear. They did not specify in the reg agenda which specific rules they're going to be revisiting. I think the expectation is we will see some liberalization of the accredited investor definition as part of that. Is it going to be, potentially as broad as, well, if you have some sort of sophisticated fiduciary making deciding on the menu of options in a 401k, then will every plan participant sort of be treated as an accredited investor? Like that would be a fairly extreme result, but maybe not impossible. Will we see some changes, maybe perhaps in line with the ICI recommendations on either a regulatory or sub-regulatory basis to allow greater investment and co-investments through of registered funds and affiliated private funds, and more kind of pyramiding of funds into funds where you're, again, democratizing the access through more retail available funds up here that are investing in less retail funds further down the chain. I think all of that is likely, but we'll sort of see how everything kind of pans out. I think we can go forward one more slide, and Erin, I don't know if you want to talk about the political issues or Rick.
Yeah, I think on the political side, there's been some of the airwaves have been the concerns about from the progressive side of the Democrats on whether these private investments are really a good thing for retirement investors. I think that again, I think it's very important that the community gets out, who the manager community, the community who really works on these products, to really get out to the public that we're not, again, talking about, the future of 401k looking in, as infrastructure and private equity funds as standalone investments. It has never been that way. And the people who are creating these products, in my view, the managers we work with are the most reputable, managers who really care about their reputation. And the only reason why they have so many assets under management is because they've been able to deliver returns to investors. So again, this is not a sudden shift. I think Empower and now other record keepers as well are including alternative asset products as part of their managed account strategies. So again, this is a managed account, perhaps a managed account QDIA, managed by a sophisticated manager who's, again, subject to the ERISA standard of care. So I think it's just, yeah, I think that we have to be very cognizant of getting the right message out on the airwaves right now. And so anyway, that's my 2 cents on this. So
Perfect. Well, you left almost 20 minutes for a litigator to talk, and so that may be dangerous here. But I want to talk about potential litigation risk and some of the fears surrounding these products, many of which are unfounded, but sort of stem from what Erin just mentioned. I think there's a lot of misimpressions about what these products look like, how they would be offered in defined contribution plans. And also from the last slide, if we went back to it, this is not, and it shouldn't be a partisan issue, but in the hyper politicized world we live in, you're starting to see sort of that polarization because the administration is pushing for something, therefore the knee-jerk reaction is it must be bad. And so that's why both in litigation and more broadly, how this is framed is very important to sort of push back on the assumptions that, as Erin and Adam mentioned, there's not just going to be all of a sudden tomorrow a bunch of standalone private equity funds on plan lineups. Record keepers aren't even set up to do that, let alone, plan sponsors and fiduciaries, agreeing to do that. And so the issue is just much more nuanced than is being portrayed. And that's consistent with how ERISA fiduciary litigation works. And so just to give you a little bit of context at the outset, if you pay any attention to ERISA litigation, there's a lot of it. And that's because there are tens of millions of people covered by ERISA governed retirement plans, whether it's defined contribution plans, defined benefit plans, in various variations of those. And so as a result of that, the plaintiffs bar is very aggressive and has been very sort of active in effectively going down the list of every major company who offers a benefit plan and looking for ways to sue them. That's not because these cases have merit. It's because, like in other areas of the law, if you can bring a putative class action seeking potentially tens and millions of dollars of damages, or at least threatening that you're entitled to that, that puts a lot of pressure on the defendants, the companies in those cases, to settle those claims. And so, really, this is a extortionary effort by the plaintiffs bar that's now going on for years to make money. And so as we show on here, so since 2022, so in less than the last 4 years, there's been more than 200 what we call ERISA excessive fee lawsuits, which are class action lawsuits challenging the administration of a defined contribution plan. And many of those have investment challenges. During that same time period, we've seen more than 150 of those class actions settle for more than $700 million. And since the plaintiffs in these settlements typically get around a third of the settlement amount, you're talking about more than $200 million going into the pockets of a relatively small number of plaintiffs firms. And so this is very profitable for them. And so they will continue to bring cases until it's not profitable. Now, I want to give the big picture view of that, which is just because there are a lot of cases and there are a lot of settlements, again, doesn't mean these claims have merit. A lot of these settlements are costs of defense and sort of cost benefit analysis from the defendants saying, do we want to spend the time, which could be years, and money, which could be millions of dollars, fighting to win these cases, or should we just pay an amount that we think is less than what it would cost to litigate to settle? And so a lot of these settlements, again, are just cost benefit analyses. But for the plan sponsors and fiduciaries and service providers and others who actually fight these claims, if you actually parse through the coverage, which is always focused on a new case has been filed or there's a new settlement, they largely win these cases. And so if you're willing to take it to summary judgment, which is the filing you submit after you complete discovery, or in some cases trial, the defendants win. The plaintiffs don't want that, which is why many of these settles come either at the outset of the case or shortly after the court rules on the motion to dismiss, which is the motion filed at the outset of the case effectively to decide whether the plaintiffs should get discovery or not. And so most of these settlements are very early on. And that fits in again with the plaintiffs bar's MO, which is let's just sue as many plan sponsors as we can. Doesn't matter if our claims don't have merit, because we know that a large majority of them will settle, and then we'll use that money to find new plans to target. And so really it's this sort of endless cycle of settlements beget new lawsuits. And so again, that has nothing to do with the merits of these claims. It only goes to, what's the plaintiff's bar's motivation, which is why a lot of the focus recently has been on what are ways, whether through legislative efforts that we'll get to or regulatory efforts, to help stem the tide of this sort of litigation. So that way you don't have fiduciaries essentially being in a state of paralysis where they say, we don't want to change anything or go out on a limb because that may put a target on our back. That's not what should be happening as fiduciaries. Fiduciaries, their role is to act in the best interest of the plan, the participants. And so they shouldn't be worried about making decisions that would be helpful to participants because they're worried about a baseless lawsuit being filed against them. But that's the environment that we live in. And so with respect to the executive order, the plaintiffs bar, because they can't help themselves, has been a little bit outspoken about it, and sort of said in various trade publications that if lots of plan sponsors adopt what they view as risky investments, litigation will likely follow. And so I just have a couple of quotes on here from two of the major firms in the space, Jerry Schlichter, who's been bringing these cases since 2006. And then Mark Boyko from Bailey and Glasser, which is a firm that mostly focuses on employee stock ownership plans, but also does other more traditional ERISA excessive fee litigation. Now, again, I think from the quotes, Jerry Schlichter likes to portray himself as sort of a champion of plan participants, but really overall, particularly in the investment space, they also are throw everything at the wall and see what sticks. And then Bailey Glass, sort of the joke, it just goes to show, they're just hoping plan sponsors do something that they can then make an optics argument to say this is risky to then file suits against them. And so I would not view any of these plaintiffs from your perspectives as sort of upstanding citizens out to protect plan participants because they're really not. In the average ERISA class action settlement, the individual participants are getting $10, $8, $12, while the plaintiffs' firms are getting millions of dollars. And so, is that worth it? Probably not. But unfortunately, they're bringing these cases in the current sort of litigation system that's set up under the federal rules of civil procedure. Now, as I mentioned at the beginning, plan sponsors and defendants, when they actually fight these claims, typically win. And we're starting to see even more victories at the outset of the case before the defendants have to spend too much time and money defending them. And in particular, investment challenges, the plaintiffs have been less successful in the past few years. Now, this is not one size fits all. If you've ever been involved in litigation, which court they sue in, so which federal court, in what part of the country and in what judge it's assigned to, can have a material impact on the outcome of the case, at least at the motion to dismiss stage, which again is at the outset of the case. Because judges, federal judges having lifetime tenure, have lots of discretion to decide, will they grant a motion to dismiss, which means lawsuit goes away, or will they deny a motion to dismiss? And there are some judges, rightly or wrongly, depending on what side of the aisle you sit on, that default to denying motions to dismiss because as a general matter, if you deny a motion to dismiss and you allow the case to proceed to discovery, that is not appealable. Meaning the defendant who lost the motion and now has to defend the case doesn't get to automatically appeal up to the appellate court or ultimately to the Supreme Court to challenge that decision. They have to wait till later stages of the case. Whereas if the district judge grants the motion to dismiss and dismisses the lawsuit, that is an appealable order that can go up on appeal. And so judges who don't want to be reversed by the appellate courts can sometimes be, reticent and hesitant to grant motions to dismiss. But as they're now seeing more and more of these cases filed, and judges don't like ERISA cases as a general matter, they're more likely to grant these motions to dismiss because they're starting to realize, listen, if I deny the motion to dismiss, I'm going to see 5 more of these. And judges, because they don't like them and often don't understand them, are more likely to take a hard look at the outset of the case. And so when we think of alternative assets, I flagged on this slide the Anderson versus Intel case out of the Ninth Circuit. This is a decision worth reading because it really gets to the heart of the matter, which is the plaintiffs challenging the investments, two of the investments in Intel's plan, which included allocations to hedge funds, private equity investments, and commodities. The plaintiff said that was imprudent. You breached your fiduciary duties, Intel, and your committee by including those because A, they underperformed other more traditional investments that could have been offered, including more traditional off-the-shelf target date funds, but also because including those asset classes as one sleeve of these investments increased the volatility and risk of those investments. The plaintiffs gave again these optics, because the plaintiffs, just like you see in, for example, Liz Warren's letter to Empower, they throw out these sort of blanket per se statements that these are, overly risky. There's liquidity issues. There's all these sorts of things, transparency issues, that don't apply to these more traditional investments. The court looked through that and said, listen, Intel was very clear in its disclosures. It included these in its plan because it was pursuing a risk mitigation objective. These are increasing the diversification of these funds. Intel knew that in an up market, these funds would potentially underperform some of the traditional, more equity heavy alternatives. But in a down market, they'd be mitigating sort of the losses and the risk that the participants would be taking. And so the judge emphasized and said, you also can't look at hedge funds, the private equity or commodities standing alone with per se challenges. You have to look at them in the context of the investments in the plan. And so you saying, plaintiffs, you just shouldn't offer any of those alternatives. That's not a valid claim because you have to look at them being a sleeve within the investments that were offered. And so ultimately, the Ninth Circuit, this case was pending for a long time and had a sort of interesting procedural history, affirmed the dismissal of the lawsuit and said, you haven't stated a valid claim. This lawsuit should be dismissed. And so now the lawsuit's gone. And that's very helpful because this is not just one district court out of a couple hundred. This is one of the appellate courts, so there are only 13 of them. And this is actually the largest federal appellate court in an area that typically has more liberal leanings that are plaintiff friendly. And so getting a good decision like this out of the Ninth Circuit has been incredibly helpful. And so the other thing to think about with this, and this sort of goes to mitigating potential risk and how you would defend these cases, is that most courts, not all, now require plaintiffs, if they're going to bring a lawsuit challenging an investment, they need to plead what's called a meaningful benchmark. Meaning you can't just say, pick a different target date fund or pick a different large cap fund that perform better. You actually have to show that the funds you're comparing the challenge fund to were substantially similar, meaning they had similar aims, they had similar makeups, they were pursuing, similar risk strategies and the like. And so not all target date funds are the same. Plaintiffs like to claim they are, but they're actually very different when you look at, for example, the glide path or the asset allocations. And, what's their allocation to domestic equities? What's their allocation to international equities? What's their allocation to fixed income products and the like? They're very different. And so we've seen a trend recently of more courts, particularly investment challenges, dismissing cases because they say these just aren't similar. And so there was a series of cases challenging the BlackRock LifePack target date funds. Court said you can't just compare those to the highest, sort of allocation to equity target date funds and say they're the same. Because if you do that cherry picked in an up market, of course, a fund that pursues a more conservative strategy is going to have a lower returns. But that doesn't mean the strategy was wrong. And it doesn't mean that the fund didn't perform in accordance with its strategy. And then I flag on here, which is another really good one to read. It's this CAE Solutions case from last week, where the court dismissed a complaint challenging the American Century target date funds, which also pursued a more sort of conservative strategy. And so these types of cases and these decisions really provide a good framework to say you actually have to peel back the layers and look at what are the investments, actually, what are the underlying investment allocations? You can't just look at the top line performance over a certain period of time, which is always cherry picked, and say, this means that the fund is imprudent. Last thing on this point, the Supreme Court has expressed interest in this because there is a circuit split, arguably, over what the standard is at the early stages of the case to decide whether it's viable or not. The Supreme Court's asked the Solicitor General to provide its views in the Johnson versus Parker Hannafin case, which comes out of the Sixth Circuit, to see how it should handle the meaningful benchmark standard. So we're still waiting to see if the Supreme Court will take that case up. But for now, there's been more positives than negatives in this space. Just a few other things. So there is proposed legislation in this space to try to make it more difficult for plaintiffs to bring these claims and discourage plaintiffs' firms from continuing to pursue this sort of cottage industry of claims. And so there are three sorts of areas that are being focused on. One is overturning the Supreme Court's recent decision in Cornell, the Cornell case, that related to prohibited transaction claims. It's less applicable in most investment contexts, but once you start getting into collective investment trusts and other vehicles where the managers are acting in a fiduciary capacity under ERISA, that case becomes more important. And so the Supreme Court's decision, which was very textualist, makes it easier for plaintiffs to bring those claims. But more importantly in this space are fiduciary breach claims. So there are efforts being made among the various trade associations to try to heighten the pleading standard to make it harder for plaintiffs to bring claims. We'll see if those get any traction. It's just very difficult in the current, again, partisan environment to get traction on both sides of the aisle for legislation like this. And given sort of the 60 vote threshold with the filibuster in the Senate, getting 60 votes to pass any legislation that makes it harder to bring any lawsuit, let alone ERISA ones, is going to be very difficult. And so I wouldn't hold your breath on these, but there's efforts being made to sort of get, again, bipartisan support. There's going to be more regulatory activity, which Erin and Adam already referenced. And we've seen already, I think you're seeing regulators move very quickly, particularly with respect to sub-regulatory guidance. So this year alone, there's already been 4 advisory opinions out of the Department of Labor, where in recent years, you've gotten 1, if that, per year. And so the department has shown that it wants to issue more sub-regulatory guidance, and it's much easier for it to do that as opposed to going through a 6-month potential notice and comment period for regulations. Dan Aronowitz, who is the new sort of head of EBSA, he was very vocal about focusing on, among other things, stemming the tide of ERISA litigation. And so how do they do that? They do that through amicus brief filings. So these are friend of the court briefs where the Department of Labor, even if they're not actually a party to the litigation, can submit a brief saying, we are the Department of Labor. Our role is to interpret and administer ERISA. We think that this case is wrongly, being pursued. And so they've already started doing that. So they did that in a case involving planned forfeitures recently against HP. And that we anticipate and sort of have heard they're going to be more active in some of the other cases going up on appeal, which can be helpful because judges do often give deference to the Department of Labor's viewpoints. Similar, we do expect there to be rulemaking, and they've said that. For example, in the news release that accompanied the advisory opinion that came out regarding lifetime income, they specifically emphasize that they intend to issue proposed rulemaking, so a proposed regulation regarding the duty owed to plan participants and how you go about deciding whether to include investments, in alternative assets, including potential safe harbors. So we're going to see at the start sub-regulatory guidance, which will be helpful because judges can consider that in deciding whether a claim is valid. But we're also going to see rulemaking, and judges do still in the area following Loper-Bright, which was a decision the Supreme Court came out with last year over the deference that must be applied to agency interpretations. Even following Loper-Bright, judges who don't understand ERISA or have a good context regarding the way retirement plans work or investment work do give the Department of Labor deference, even if they are sort of judges that were nominated by, potentially, a different party than the judge, than President Trump, for example. And so that will be very helpful with respect to that. The last thing I just want to mention on the slide, and I know we're at time, is there's been a lot of discussion about safe harbors. Safe harbors are very helpful because they set forth the department's views. And it also means that if you satisfy the requirements of the safe harbor, the Department of Labor is not going to bring a claim against you. But a safe harbor does not mean you are immune from civil litigation brought by plaintiffs' class action firms. That is because the safe harbor requirements don't bind necessarily civil parties. That's the first thing. The second thing is the safe harbor, for it to be effective, needs to be consistent with ERISA statutory text. And so the Department of Labor can't come out and say, although ERISA 404 sets forth fiduciary requirements, these no longer apply. It can't do that. It can't change the law through regulation or through a safe harbor. The other thing they can't do is they can't extend the scope of ERISA in a way that's contrary to the statutory language. And so you can see if the safe harbor that the Department of Labor comes out with is too broad, you can see plaintiffs bringing claims challenging that safe harbor and saying that it should be invalidated. Just like we saw plaintiffs bring claims challenging regulations and other rulemaking under the Biden administration. So you can see the same sort of flip argument. But at the same time, and this is very helpful, is ERISA claims are generally, other than some exceptions within the Second Circuit, are decided by judges. And so judges are always hesitant to penalize any plan sponsor or fiduciary if they are complying in good faith on agency regulations, sub-regulatory guidance, or safe harbors. And so even if these don't stop you from getting sued, your courts are likely going to credit you if you try to comply with this stuff, even if they disagree with them, in trying to award any sort of damages against you. And if we get down that path, again, the plaintiffs hold your role here, and what they're trying to do is to extort money. If they don't see a light at the end of the tunnel in terms of a big pot of money, they're much less likely to bring claims. And so all of these things will sort of move us in a direction where there won't be claims. And so I'm mindful we went over. I didn't leave Adam or Erin time to chime in, although I think if people are still on, happy to take any questions anyone has.
Great. I think, yeah, Kelsey, I think we may kick it over to you. Thank you, Rick. As you know, we spent another 2 minutes on litigation because we know that has been the biggest roadblock and obstacle with respect to getting these products in more defined contribution plans. So thank you, Rick. Thank you, Adam, for the additional color. And it's been a pleasure. And feel free to follow up with any one of us with questions. You know where to find us. Thank you.
Everyone will send the recording out. Appreciate it.